But we better check the markets. It's a Monday morning. You always want to know where your money's going. A solid green, I'd say. 80 up for the Dow, 90 for the Nasdaq. Jason Katz with me this morning. Now, Jason, the level on the Dow at the moment is 38,700. On this very program, not that long ago, you said 40,000 on the Dow is coming. You're holding that?
Not exactly the most profound target here. We're talking about 2.5%, 3%, right?
I just thought I'd ask.
Right. So the April brief showers are going to bring May flowers, but for Dow-related stocks. And that's because they're the most economically sensitive. They're the ones most tethered to interest rates. So you look at the disparity in valuation between the Nasdaq, S&P versus the Dow. I submit to you that the S&P and Nasdaq don't get much higher from here, whereas the Dow has substantial upside.
Why? What's so special about the Dow? Just those 30 stocks?
Well, it's not so much the 30 stocks. It's that if you believe that a recession could be avoided, or it could be a soft-ish landing, you're looking at around 16 times earnings for that constituency versus over 21 times for the S&P and even higher for the Nasdaq.
Do you think we'll get any rate cuts this year?
So the Fed really hit the ball right down the fairway. The porridge wasn't too hot, it wasn't too cold, and what they're doing, and they've come under a lot of criticism, but frankly, it's working, right? You're seeing wages modestly come down. Jobs are still plentiful, but we're seeing that wane as well. And you're seeing the earnings of consumer companies start to come down a little bit as well. It's counterintuitive, but that's exactly what the Fed wanted. So rate cuts are not canceled. They're just simply delayed. And one other thing worth noting, and it's sort of technical, and I won't go down this road, but they did say they're taking their foot off of what's called quantitative tightening. They're taking the foot off of that gas pedal, meaning that they're going to continue to buy some bonds in the open market. That effectively is incremental easing. So we're already going down the road of cutting rates.
Absolutely. This quantitative whatever, that's taking money out of the economy, which is what they're doing now. But you say that if they stop doing that, they'll be putting money into the economy. And that's the equivalent of a rate cut?
Effectively. So quantitative tightening is like owning a bond portfolio. When you have a bond mature, you tend to recycle it and buy a new bond. And what they were doing was letting their bond portfolio run off. Now they're going back and buying a little bit more bonds. That's effectively monetary easing.
It is, isn't it?
It is.
It's the other way around. That's interesting. Jason, good stuff. Thank you very much, sir. See you again soon.